Thank you, David, and thank you to the LBMA for your gracious invitation. This is not my title itself, but I'm known colloquially at HSBC as the biggest gold analyst in the world. But I don't believe they mean it because of my intellectual capacities. I think it's something else. I get some rivalry from a few others, but I've seen them off in the big department so far. Just one or two things quickly. Paul, you'll never need to prove your intellectual vigor or courage again after hearing that you read that 585 Brexit report. Kudos to you. And Fergal, I'm surprised if you weren't looking for first-hand information on the gold market during the World War I and shortly after period, that you didn't go to the source, which would be David. He would be able to clue you in from his earlier days in the market, no doubt, from nothing like experience, you know. Well, gold up to 2030, I mean, and I don't want anybody to think that I have a crystal ball on how the world is going to look in 2030, but we do have an excellent economics team at HSBC, and in particular Janet Henry, who put together something very interesting on 2030, and I've taken that and applied to it what I think it will mean for the gold market. But just something very basic to look at, and I think this is often forgotten, but you do see it in the trading markets, is if you look at the red part of the world, this is the part of the world that views gold as a currency. And these are places in the world that historically may not have had stable governments, may have had arbitrary seizure of property, some higher level of geopolitical risk, non-democratic changes in government. I'm not saying now, I'm just saying historically. Weaker financial institutions, particularly central banks, whereas the area, basically the OECD world, they look at gold as a commodity. And that's because of historically sounder financial institutions. And it's important because you even see, when I watch how gold is trading, you even see different parts of the world and investors in different parts of the world react differently to the same data. And I think part of it has this complexion. And so it's important to remember the dual nature of gold going forward, because I think it will also apply to gold in the future. Well, gold going forward, and I mean by 2030, will still be a function of global growth, but importantly, the split between emerging market growth and developed market growth. And particularly, not just the split, but also the distribution of income within both developed markets and emerging markets. Consumer spending habits, of course, will change, as was pointed out earlier. Demographics are going to be important. We have younger population in most, but not all of the emerging markets, older populations in most of the developed markets. The risk factors will remain economic, financial, and geopolitical. Now, our view right now is that in the near term, the divergence would be that the US economy may still be booming, at least up until very recently, but the global economy is starting to slow, and the stresses caused by divergence will play out uncomfortably in emerging markets. But in the longer term, emerging markets, and that's what's important for gold, in the longer term, up to 2030, emerging markets are set to power growth mostly through demographics, and that will begin to increasingly weigh on developed markets. So rather than developed markets impacting emerging markets going to impact more developed markets. In fact, by 2030, I'm sure we won't be calling them emerging markets anymore. They will have completely emerged, and many of them have also completely developed. Now here's our view on long-term GDP ratings. Right now, the US is the first, and China is the second, with, and you'll have to excuse me, I just had an operation on my eyes, but around 20% and 14%. That will change by 2018. China will assume the first position, the US the second, but they'll be very, very evenly divided, very closely divided between the two. So it really could go either way. But we think by 2030 that China will just edge the US out. Someone please alert the US authorities right away. But if you think about this, the combined GDP that we're looking for in 2030, of over 50% of global GDP will just come from two nations. So we really should look at the gold consumption and likely gold consumption in those two areas. But what's also important is look at the jump in India, a very important gold importing country and consuming country. That jumps way up to 6.9%, and other countries that are less important for gold are beginning to move down. China and India, as we just said, largest gold consumers, are projected to increase their global rankings in 2013. The biggest risers, however, smaller emerging market nations, also coincidentally have a growing appetite for gold. So those that are on the way up have a greater appetite, greater predilection to wanting gold. Those that, and when I say down, when I say down, I mean relative to the rest of the world. I don't mean that we don't mean that these economies are sinking by any means, but those that are going to fall in the global rankings, have less of a predilection to own gold. And that's the important thing. That's the thing that I want to sort of drive home. Global growth, in our view, our forecasts going out are for 3%. Growth out to 2030. It's a bit lower than if you were to take the entire average. Of course, we have had periods historically where because of rebuilding and things like that, growth levels were higher. But this is enough, in our view, to support things like jewelry demand, coin demand, to support the luxury good element demand of gold. Now, for example, the Philippines and Vietnam, we've estimated that they will rise sharply. Those countries have a growing appetite for gold. Norway, Denmark, Finland are falling in rankings. They have relatively low appetites for gold. Now, here I took World Gold Council data, and looked at gold per capita consumption per year. Now, I admit in some countries there's some export levels. We had to sort of smooth those out. But if you look at China and India that are both in the black there, both those countries are relatively low per capita consumption of gold, of less than an ounce per person per year. If their GDP keeps rising, and in the case of India, the population keeps rising, then that's likely to mean greater gold consumption. If they move to anything like, say, for example, South Korean consumption, and we know that Chinese buying patterns tend to follow Korean, not on purpose, just coincidentally because of the expansion, then that would mean considerably more gold consumption, even assuming a slight decline in per capita demand. So the majority of physical gold is already imported and consumed in emerging markets, no surprise there. The greater economic growth and rising income will support gold demand in these nations. And we all know all these things, and we can all look at it, but I think it's interesting just to see how much we think these countries are going to expand compared to everybody else. And what's interesting, too, is the countries that are losing ground economically don't have a high predilection to keep buying gold anyway. So they're not going to be as great a loss to the gold market as one might have thought. And by 2030, 70% of growth will come from the emerging world, where gold demand is rising. And this is really important. Look at this. Look at the increase. In America, everybody is middle class, right? 75% of the country. Even the data even shows that even those that are relatively not well off or very well off still regard themselves as being middle class, even though technically they don't come into that category. But 75% or so of the population. And look at the growth that we expect to happen in China, Philippines, India. I mean, these middle class purchases are going to absolutely explode. And this is that, we took World Bank data and looked at what point are you most likely to start to buy some gold. And of course, we're all familiar with the potato meat argument, the rice meat argument. When you get the income and substitution effect, when you increase your income, you stop buying rice and potatoes, you start buying more meat, et cetera, et cetera. And as you go up, you buy clothing, then you buy an automobile, and then you buy a house. Well, we're reaching levels, we will increasingly reach levels in the next 2 years that enough of the middle class will be wealthy enough to start buying more precious metals. We know that the center of this is in Asia. And here's what I mean by that. As consumers grow richer, their spending habits change. Now, you can't delineate it narrowly enough to show that, to show exactly how much is going to go into bullion. But you see here, there's going to be a reduction in what the average person in emerging markets is going to spend on food and beverage. It's going to increase on certain critical issues, and within that luxury goods frame, such as clothing and footwear, after the necessities are taken care of, it's going to increase into gold. Just a minor spillover. We don't need much. I mean, if you took all the gold in the world right now and you added it up compared to all the financial assets, gold is still well under 2%. So we don't need a lot of leakage coming into the gold market for it to have a big effect. And by the demographic argument, you'd have to watch out for Africa and Southeast Asia, who have the youngest populations to be emerging gold buyers as well. I should say one thing very quickly. The age issue, and a big negative for the gold market could be the age issue in developed markets. As we're older, we may start dishoarding more and more gold. I know this is an issue in Japan right now. It may become an issue more in the US as well, but not immediately, but possibly in years to come. It's difficult to say right now whether the US gold holders will dishoard to the level that we have seen in Japan in some recent years. Japan is the oldest population in the world. I think about a quarter of the people are 65 or over. So consequently, we have to watch out that as a negative. Will that be more important on the way down for gold than the emerging market buyers buying it on the way up? Just to confirm something, I thought it was very interesting what Tsuki had mentioned about trade. What we did was we looked at growth in world trade against the gold price. And you see here, during periods where growth is high, in trade that is, economists tell us a whole range of things. Inflation's likely to be low because the cheapest goods and services are being traded. You get a lot of cross-border immigration, you get a lot of cross-border capital flows. Those countries that participate in growth are likely to have outsized GDP expansions as well. Economic policies tend to be more in sync. You don't get so much things like currency wars. Geopolitical risk tends to be lower because everybody's trading with each other. You don't argue with your neighbors if you're trading with them. So, would you really want to have a lot of gold in that instance? And no, probably not. But when you see here during the crisis, when trade almost collapsed, contracted 35 to 40% at one point, albeit there's a lag, and I admit that, but the gold market took off. Now, currently, trade is still bumping along quite well. I know if you were to read the newspapers, you'd think it wasn't, but it is. And to Suki's point again about the tariff issues, if trade begins to take a dive, it hasn't yet, but if in fact it's recovered in the past couple of years and the gold price has eased, you would think that the gold price might rally. So I don't know what the trade situation is going to look like in 2030, but if it's more of an anti-globalization world than a pro-globalization world, it would be good for gold. Just quickly here, because I want to keep within time. I have a friend that's going to raise the 5-minute mark probably soon, right? The commodities. Now, we're looking for oil prices to rise. We're not making forecasts out to 2030, but it does appear that right now they're too low. We're looking for some more tightness in supply. If you take the broad perspective that commodity prices are likely to be higher, 5 minutes right away, okay, then I think that's likely to be supportive of gold as well. Well, I would like to our conclusions there is that despite risks, the emerging markets will still have higher long-term growth potential. That will mean they will have a bigger impact on developed markets, but we'll have policy challenges in developed markets as well. Global income and GDP will begin to favor bullion because of those nations have a higher predilection to import bullion, even assuming that on a per capita basis they begin to, on some income levels, purchase less. Aging populations in the West could be negative through dishoarding. We know what the demographic situation is going to look like. And as far as the demographics are concerned, the Indian population is still rising. China is peaking, and that could mean that the emphasis will switch again from China being the world's #1 gold consumer back towards India, which has been the historical case. Trade dislocations would work in the favor of gold. But assuming that the forces of globalization win out in the longer run, that would be a negative. Oh, I was going to show you our marvelous disclaimers, which you can certainly have if you want. I'm sure they're just as interesting as the Brexit paper, but nonetheless, one thing I didn't go into is on the supply side for gold, and I'd like to make just two sort of comments on that. One is that major producers have had difficulty replacing their reserves in the last number of years. Gold production has continued to rise despite a lot of obstacles, but we do know that they've had to go further afield. We've been looking for gold for thousands of years. We've only been looking for oil for about 150. So there's a big difference. We've traversed a lot of ground looking for gold. We have to go higher into the Andes and deeper into West Africa and Papua New Guinea and places like that. If you take, you're much more likely to see a peak gold argument than a peak oil. There is no peak oil argument, but there is possibly under certain circumstances, particularly if prices don't rise significantly, a peak gold argument. So you may also see a topping out of gold production throughout the period when the demand for gold is going to rise. Now, how are you going to plug that gap? Well, we do know through the World Gold Council's excellent statistics that there's something like 180,000 tons above ground, so there's no shortage of gold. But it might have a psychological impact on the market if the mines are not able to keep producing more. And additionally, for the recycling market, we might need higher and higher prices to keep encouraging that recycling to come in. And it was one of the things I'd remind everybody that helped kill the rally back in 2012, 2013 was the gold price went to 1900 and we got a lot of scrap coming into the market. So depending upon what prices are out in 2030, the scrap market will also play a role. But we won't probably see a lot more gold output. And that, I'm glad it's 15 minutes because that's exactly how much I know about this topic. I don't know if we were to go for 2 more minutes, my lack of knowledge, my paucity of knowledge on the subject would be laid bare for all of you to see. So thank you for making it 15 minutes all right. Checks in the mail. Is there any, thank you. Do we have time for, if there are any questions? There may not be. I hope if you're at least confused on the subject, you're at least confused at a higher order than you were before this all started. But I'm around all night. Please don't forget to tip your waitress. Thank you very much, everybody.